Hello, everyone. Happy Friday. Again, we are here, Monica Davis Group, providing you the best information for you and for the future of your families. Today, we have a very important topic, and is how should I start to be a homeowner? What is the best steps for you to get approval? There are different type of loans that are provided as a homeowner. So if you are thinking of buying, today we have Ivan Severiche from Loan Depot, who will be inviting us and guiding us through the process of how to become a homeowner through a loan process and what type of loans are convenient for you. Welcome, Ivan.
Hi, Monica. Thank you very much. Thank you, Carolina, for having me here. My name is Ivan Severiche, and I'm a mortgage loan officer with Loan Depot. I've been in the business for many, many years, and I'm here to help you become a homeowner.
Great, thank you. So tell us about where should they start? Nowadays, it's complicated for them to know, oh, this type of loan is convenient for you, this other type of loan is convenient for you. But in reality, they don't know how to start. They have heard from us that the number one thing is to find someone like a realtor like us to guide them through the process. But then we need an specialized person like you, a professional like you, who are going to guide us through the process on what type of loan is convenient for them. Okay, so with that in mind, what kind of loans right now are convenient, are the most popular for home buyers right now that are looking forward to buy a home?
Well, yes, basically, if you need financing in order to purchase your next home, the most important part is to have the financing part done first. Get your pre-approval letter. So when you go out there to look for your home, the first thing that the seller is going to ask you to provide is going to be the pre-approval letter. So that's the first step, getting pre-approved, making sure that when you go out there, you're not going to have any problems with the financing. There are different types of loans. There are conventional loans, which are basically what they call Freddie Mac and Fannie Mae loans. There's also an FHA loan, which a lot of people call it a first-time home buyer loan, but it's not for first-time home buyers. Maybe in the beginning it was, now it's not. And there are also loans like specialized loans like the VA, which are for veterans. The three loans are a little bit different. The conventional loans, which are the Freddie Mac and Fannie Mae loans, those typically consist of either 3%, as low as 3% down payment if you are a first-time home buyer. If you're not a first-time home buyer, you do need to put 5% down. And if you put 20% down, you don't have to pay private mortgage insurance. Those are actually what you call a conventional loan. There are also loans such as the FHA, which is what people call the first-time home buyer loan. On those loans, you can put a 3.5% down, and the most you can finance here in Florida, it's actually $373,750. With the conventional loan, you can go all the way up to $510,400. And then with the VA loan, which is the loan for the veterans, those you can do 100% financing.
Very good, very good. Okay, so we have conventional, right? We
Correct.
have FHA, we have VA loans. Those are the three most important loans that we have right now, right?
That is correct. That is
Okay.
correct.
And you have mentioned that FHA is not only for first-time home buyers, right?
No, it's not. It probably was at one point a first-time homebuyer program. Now, even if you've owned homes in the past, you can apply for an FHA loan. The only thing is that you cannot have two FHA loans at once. So if you have already a house and you have an FHA loan on that property, you cannot get a new one. But if you don't, yes, you can get an FHA loan. It's basically a loan. Like I said, you can finance up to $373,750. And the good thing about the loan is there's a lot of pluses that the loan has. Basically, if your credit is not the best credit, that loan, the FHA loan, allows you to still become a homeowner. such as, I mean, you can actually purchase a home with a credit score as low as 580 credit score. With a conventional loan, you cannot do that. You have to have better credit, and obviously the down payment is obviously a little bit higher. But the FHA loan, I think it's a very good product for those individuals that maybe they don't, their credit's new, maybe they don't have very high credit scores, maybe they had a little bit of issues with their credit in the past, but they still want to become a homeowner. That product is a very good option, also because it's only 3.5% down. Another good thing is the FHA loan. You can use up to 57% of your income to allow you to buy a home. On the conventional loan, it's only up to 50%. So the FHA loan is good for that individual that needs additional income. They need that 57% income in order to be able to qualify for the home that they're buying. On the other hand, the VA loan, that one is only for veterans. It's not for everyone. But if you are a veteran, you can actually purchase a home, and you don't have to put no money down. The only thing that you would pay would be your closing costs.
Very good, very good. Okay, I have heard, and we have situations like that with some buyers that they put in a conventional loan as low as 3%.
Mhm.
Or as low as 5%. Before it used to be 20% down. Things have changed. Can you explain to us a little bit more about that?
Yeah, well, if you are a first-time home buyer, you can do a conventional loan with 3% down. If you're not a first-time home buyer and you've owned homes in the past, you would have to put 5% down. But 20% down, it doesn't have to be 20% down. You can put 20% down. The good thing about putting 20% down is that you don't have to pay private mortgage insurance with the conventional loan. But no, you don't need 20% down if you're a first-time home buyer and you qualify for the 3% down conventional. You can do 3% down, or you can do 5% down.
Okay, now that you mentioned the PMI, the private mortgage insurance, can you explain to us more in detail what is this? Why do they have to pay this insurance if they're not putting 20%?
Well, basically, the way it works is anytime you buy a property and you put less than 20% down, the financial institution is going to put an insurance on the loan. It's called private mortgage insurance. And it's basically an insurance for the lender in case of default, in case the buyer ends up having issues and can't pay the house. That insurance covers the lender. Now, if you put 20% down, you don't have to pay private mortgage insurance. The good thing about the private mortgage insurance with the conventional loan is, let's say you buy a home and you do it the conventional loan. If you put, let's say, 5% down, the private mortgage insurance, you will only pay it until you reach 80%. So when you pay 20% of what you bought the property for, it automatically drops. You don't have to pay it anymore at that point. On the other hand, with the FHA loan, being that it's a government program, you do have to pay MI. They call it MI. It's the same thing, more or less. But on the FHA loan, you do pay for it, and they never drop it. It's actually throughout the life of the loan. If you want to remove it at some point, the only way to remove it is by refinancing. But Loan Depot, we offer free refinances. So basically, if you get a loan through us, and you get an FHA, let's say, and in the future you want to refinance because now you don't want to have the private mortgage insurance or the MI, we can refinance it. And because you are already with Loan Depot, your loan is with Loan Depot, we refinance it for free.
Okay, so what I see is that the FHA loans also have a high risk because if they're taking buyers with low credit and things like that, they still have to get a chance to buy a property. But for them, it's a low risk. That's why they keep that insurance for the maturity of the loan, right?
Yes, that is actually the way it works. Yeah, because it's a government program. I think that the government basically they want their loan to be insured throughout the life of the loan. But I believe, honestly, that the program is incredibly good because it gets a lot of people into homes. Like I said, those individuals that they want to become a homeowner, but they've had some issues with credit in the past, that's a perfect loan. And especially also, like I said, it allows you to buy more home than the conventional because you can actually, they use 57% of your income at this time.
Okay, I have a question for you, Ivan. If let's say we have a scenario of a home buyer that you're doing the pre-qualification, okay, you as a professional decide if it's convenient for them an FHA or conventional, or based on the criteria that you receive, the buyer is automatically set into that type of loan. Okay, because I had a scenario before where we had good credit, we had excellent credit, good income, but the person had a FHA loan.
In all honesty, I don't understand why that happened. I mean, normally what we try to do is in the beginning, we try to we try to get them into a conventional loan. If
Mm-hmm.
they qualify for the conventional loan, we try the conventional loan. If for some reason we have to, let's say, go over the 50% DTI, debt to income ratio, then at that point, yes, they would, maybe we will go ahead and offer them the FHA loan. But no, I mean, typically when someone applies, the first thing we do is we try to get them on a conventional loan. That would be the ideal. Then if that doesn't work for whatever reason, we use the FHA as another option. But in that case that you mentioned, I don't know why they would try to put the borrower on an FHA loan if they did qualify for a conventional loan, being that the credit was excellent, being that the income was there.
Yeah.
I don't know what happened at that point. Yeah.
Okay. 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 Something for for us to think about. Okay. And okay, so now we have learned some more in detail about FHA and conventional as well. Okay. What about the time frame for closing? Is it the same
Typically,
time?
yeah, no. Typically, loans, at least with Loan Depot, we close them within 30 days. Within 30 days, you should be closing your loan. I know sometimes people say, "Oh, FHA loans take longer." In our experience, it's not true. I mean, we close them all the time. Actually, we have closed some of them in less than 30 days. But the time frame more or less on a mortgage loan is 30 days from beginning to end. That's typically what it takes.
Okay, very good, very good. Do you have any questions, Carolina, about this?
Yes, yes, Monica. I wanted to know if Ivan could talk to us a little bit more about what type of paperwork or documentation you need for each of these mortgage programs.
Yes. Okay, well, the paperwork is typically, I mean, if you are a regular W-2 income employee, let's say you are on salary or hourly, you typically just need like two pay stubs, the latest ones, your latest two W-2s, in this case would be 2018 and 2019, a copy of your driver's license, and two latest bank statements. That's all we need for the approval. Now, if you are self-employed, or if you own a corporation, then you will need the additional documentation, which would be 2 years personal tax returns, 18 and 19, and 2 years business tax returns if they're business owners.
I see. Excellent, excellent. And for a self-employed person, which loan program would you recommend the most?
I mean, with a self-employed person, it doesn't matter. I mean, like I said, we try the conventional loan first, and if that works, okay, that's fine. We can go with the conventional. If we have to switch to the FHA for whatever the reason, maybe because the income is not there, we need a little bit more income to allow them to qualify, then we give them the option to do the FHA. Both programs work very well.
Okay. Now,
Okay, thank you.
could
Thank
you
you.
explain to us at the time how is the process? Okay, they get pre-qualified. What is the difference between a pre-qualified letter and a DU?
Well, let me tell you the difference. This is pretty good. That's a very good question. There are pre-qualifications and there are pre-approvals. Normally, a pre-qualification is when someone applies, gets approved, but does not provide any income documents. They don't provide assets. They don't provide their income, and many times they don't even pull credit. That's a pre-qualification. And basically a pre-qualification is basically worthless. On a pre-approval, basically when you get a pre-approval is because credit was ran, so the credit was checked, the income was calculated, so it was verified that they do have income and that they do qualify based on their income for that property that they're going to be buying, and the credit was pulled and checked and made sure that everything was going to work. The DU is basically the approval from Freddie Mac or Fannie Mae or FHA. When you run it through the system after you have verified income and you have done all, pulled credit, checked everything that you needed to check in order to make sure that they do qualify, you run it through Freddie Mac, Fannie Mae, and you get a DU approval, let's say. Many realtors love to use the DU when they're placing an offer because a lot of people that look at it, when they see that there was a DU, they automatically know that, okay, in order to get a DU, you really have to pull credit, at least pull credit. So at least there was an intent to put an application in the system and pull credit. And it's not just a pre-qualification per se, where they didn't do any of these verifications, and now you really don't know if this person really is qualified or not. So that's a very good question.
Very good. Yes. So it is very important to understand what is a pre-qualification and a pre-approval, right?
That is correct. Yes. What you want is really a pre-approval. You want to make sure that that you have been pre-approved, that everything was checked, that you provided your income documents, that you provided your bank statements, that we know you have enough income to be able to close on the property. So when you get into that contract, you know that you're going to be able to close and not have any issues with the financing. So it's very important to have a pre-qualification from a good source, someone that did everything that needs to be done in order to get that approval.
Okay, Ivan, another question. Okay, why most of the realtors, and especially nowadays that there is such a low inventory and it's competition for buyers to try to get a home, why real estate agents ask specifically for a DU? Is it allowed to show? Some say no, others say yes. Could you please clarify that for us?
Some financial institutions will not give you a DU. Some. Because in reality, the DU has a lot of personal information. So many times, a lot of financial institutions will not give you a DU. I know realtors like to ask for it, and many of us will give you a DU, especially if, let's say, the borrower says, okay, you can go ahead and share it. Normally, we would want to share just the first page. That would show that it went through DU and it got approved, and it has the name and it says approved. But a lot of realtors like to use it, like I said, because when they place an offer, it tells the listing realtor that yes, a credit was pulled and he went through DU for that approval, and an application was actually taken. So that's mainly why people ask for it. But many financial institutions won't share a DU in many occasions because, like I said, there's a lot of personal information that's actually in the DU.
Okay, very good, very good. Okay, if we come across with more questions about these two type of loans, we will go back to them. Now we're going to go into another type of loan, which is a VA loan. Okay, so this loan applies for veterans or people who have worked in the government area. Most of the time, these loans are 100% financed. Can you tell us more about this type of loans, Ivan?
Yeah, I mean, basically is if you have VA benefits and you are eligible for the VA loan, which the way you find out is if you contact the VA, they will let you know if you are eligible for the VA loan. And basically the way it works is you can actually buy a home here in the state of Florida up to $510,400, and you can use the VA loan, and if you qualify, you can do 100% financing. You don't have to put a dollar for down payment. You do have to pay closing costs, but at least down payment would be zero. In some cases where the veteran, let's say, has I forgot the name of the benefits, but they are benefits when they got hurt. Like if they got hurt in war, let's say, they get special benefits where they can actually go even over the 510,400, up to $1 million, and still be able to buy a property with just with nothing down, basically just paying closing costs. So it's a very good loan, especially for veterans that are eligible for it. They can take advantage and become homeowners and not have to put nothing down. Very popular program.
Okay. Now, the interest rate, because of the great benefits that VA had, are going to be lower with this type of loan, or is the same, or it depends on the credit and things like that, the criteria of every borrower?
Yes, all programs, the conventional, the FHA, the VA, on all programs, the better your credit, the lower your rate's going to be. So yeah, credit does play a very important role when it comes to your interest rate. The programs like the VA, they work the same way. The better credit you have, the lower the interest rate. But right now, the rates are very low. So I would recommend that if you want to become a homeowner, you should take advantage of the rates right now because the rates are very, very, very low. And if you have really good credit, you can get rates as low as in the twos, 2.5, 2.75, 2.99, depending what you're buying, depending how much down payment you want to put down. But the rates are very low. So by the rates being low, this allows your payment to be lower, and it also allows you to qualify for more home. Let's say the rates were at 4.5. Now you don't qualify, let's say, for 300,000 because rates are 4.5. But maybe because rates are now, let's say, 2.99, you can now probably qualify for a $300,000 property. So the idea would be to take advantage of the low rate. I know inventory is kind of tight right now, as you guys must know. You guys are realtors. It's very tight, but right now the rates are so low. The idea would be to take advantage of the rates and go out there and try to see what's available. But the most important part, obviously, is to be pre-qualified. So when you go out there, you go out there and you start looking, and you know that you have your financing in place, and that you're not going to have any problems with the financing.
Okay, very good, very good. Okay, I have come across to a scenario, and especially if there is, for example, a scenario of an offer of 20% a conventional loan down and a VA loan. Okay, the VA loan doesn't provide the DU. The conventional loan, in this case, provide the DU, and everything look good. In this case, well, it's at the seller's decision to decide what offer is he going to take. But per your experience, what will be the best option to take?
Well, basically, what happens is the sellers, especially now, like I said, being that the inventory is so tight, I'm sure sellers are probably getting several offers. Now, if you get an offer, let's say someone sends you an offer and the offer is a conventional loan, 20% down with the DU, let's say. And now you have another offer where it's 100% financing because it's a VA loan. There's a possibility, a very big possibility that the seller is going to take the conventional loan with 20% down first and maybe put the VA as a second option. So yes, I mean, that's happening now because the inventory is so tight. But nevertheless, the program is a very good program. I have helped a lot of people with VA loans, and they have found homes. It's just that right now, yes, it's a little bit more difficult for that individual that has that, there's the sellers are getting, so many different options and so many different offers that it can be quite challenging to have your offer accepted. But nevertheless, I mean, many people get into homes with 100% financing with the VA loan.
Okay. Okay, perfect. Do you have any questions, Carolina, before we go to go and review if the audience have any questions right now or something that you would like to add.
Uh, yes, we wanted to know, in case where you have an offer that is over the asking price, and it's somebody that is using financing, what happens when the appraisal comes under the asking price?
Well, basically, normally what happens is you get a copy of the appraisal. The realtor, the realtor will get a copy of the appraisal, and obviously, most of the time, it goes back to the seller. It goes back to the listing realtor for renegotiation. Now, sometimes the seller will probably come down because obviously they want to sell the property and so on. But in many occasions, especially now, where inventory is tight, you sometimes see the buyer also saying, you know what? It doesn't matter. I'll pay the additional $5,000. In events where obviously there's a big gap, 10, 15, $20,000 difference in price. At that point they got to go back to negotiations, and either the seller lowers the price, or we end up not having a sale, and everybody has to go back out there and look for a new home. That happens as well. But the idea would be for the seller to lower the price, or to have a negotiation where seller and buyer are happy. But you do see this happening often where sometimes offers come down, the appraisal comes in a little bit lower than the selling price.
Okay, perfect. Yes. And something very important that you mentioned, and is
Okay.
this is educational for the buyers. If, every time you buy, you are in under contract with the property, the buyer always pays for the appraisal. Okay. And
Right.
also, the lender is the one that requests the appraisal. So you pay for the appraisal ahead of time with the lender, right, Ivan?
Yes.
And the lender is the one who requests the appraisal. The appraiser is going to call the listing agent, okay, to make arrangements to go and visit the property. Right now, due to COVID, many appraisers are doing the appraisals virtually, where real estate agents need to write in detail the value, the comparables and the value of the homes. Okay, so it's very important to take this in consideration if you're buying a property, to let your trusted realtor know what, and to for you to also be informed about what could happen during that time. Okay,
Yeah.
how much
Basically,
usually is an appraisal now?
appraisal is typically $475, and you can pay with a credit card. And basically, the way it works is once you have been pre-approved and you got your letter, you went and you put your offer, you come back already. Okay, so I got my offer accepted. Now the next step is to send the loan to processing. And basically, while the loan gets processed, we order the appraisal. We need to know, and obviously the buyer needs to know how much the property is worth. So we order the appraisal. The appraisal takes a few days. It doesn't take that long. Normally, we have an appraisal within 4 or 5 days. And yes, and now with COVID-19, there are some appraisers that are not going into the property. And basically, what they do is they look at the comparables in the area, the latest sales in the area, and many times are using the pictures from the NMLS as to be able to access the property inside, to have an idea of how the property looks inside. Some appraisers are doing that. Some appraisers are actually, in many events, they do sometimes have to go to the property because for whatever the reason, maybe the pictures are not the best for the NMLS. Maybe they have a hard time finding a property or cells in the area that are similar to the property and they need to go in. But yes, you do have appraisers that are not going into the properties at this time. And the appraisal is very important. The appraisal lets the buyer know if what they're paying for that property, it's if the value is there. That's it protects the financial institution, the bank, and it also protects the buyer. So it's very important.
Okay, very good, very good. Okay, and like Ivan mentioned, okay, if the report comes lower than the asking than the asking price, or the price that was agreed between buyer and seller at the time of the offer, there are different types of negotiation. One, that the buyer is requesting that to pay the regular appraised value, and nothing is going to change the terms of the contract. The only thing that it will change is the price. If it comes lower, then you, let's say if it comes $10,000 lower, and you agree with the seller at that price, then the amount of the loan and everything, all the rest of the terms will be modified with the new price, right, Ivan?
That is correct. That is correct. Yeah, normally, yeah, you get the appraisal. It goes back to you guys, and you guys got to negotiate. Um, where you got to at that point it goes back to you guys, and you negotiate the new price. That's the way. That's the way it normally happens.
Okay, now something very important that I want to point out to you is nowadays, since inventory is low, we have repeated several times during this webinar, buyers are asking above asking price to get the property, okay? But many buyers don't understand that if they put an offer and the appraisal comes above asking price, you may be in the situation that you have to pay the difference. So make sure that those clauses are established in the contract. Like you can put, for example, if the property is in the market for 300 and you want to go above and beyond because you just want to buy the property and you put it for, let's say, 305 or 310, okay? Make sure that you put your appraisal contingency, and if you are going above asking price, that property needs to be in agreement in both sides. Like, for example, if you're going to pay above asking price and if the appraisal came lower, that you're going to meet certain time. Okay, everything has to be in writing in order at the end to be in good position for you. Okay, and if you have more questions in detail about this, we will be more than happy to assist you and to serve you and to guide you through the process. But this is something very important that you have to keep in mind. Next webinar, talking about title commitment and the lending process, which is very important for you to know and understand. We thank you very much for staying in tune with us. Our goal is to provide you the best service possible and guide you through the process. If you would like to go back into this webinar, you just can find us into our social media, Facebook, Instagram, LinkedIn, and will be happy to help you and, like I say, guide you through the process. We wish you a wonderful Friday and a wonderful weekend. And if you are house hunting, please be very smart of the offer that you're presenting and be ready for that. And for that, you need the best and trusted realtors around you, and we are here, Monica Davis Group, ready to help you and to serve you. Have a wonderful weekend. Bye bye.